Hey everyone, this is Michael, and this is the Market Trend Advisory video for February 6, 2022. I'll try to keep this one pretty brief. We're just going to go over the current market trend and see what's going on there. Before we start, we just have our disclaimer, and I'll just mention that the content and information in this presentation is provided for educational and informational purposes only, and in no way should be considered investment advice. So let's go ahead and look at where we are for our market trend. We started a confirmed uptrend on Monday, and the market's been kind of holding in there. We're showing that we have all green lights, it's a good sign. We do show the market trend is uptrend strengthening for both indexes. We're on hold in terms of the action signal just because we're kind of waffling about quite a bit. Nasdaq's below its key moving averages and S&P is in between them. In terms of individual stocks, we're basically at small pilot positions or no positions because they're really not working. There's not much merchandise breaking out except for oil and gas stocks, a few other commodity related stocks. Most growth stocks are just broken and in some cases broken in two, with all sorts of major damage going on. So most of them are nowhere in any position to be bought. They're just heading straight down and need to be, come off their lows, form some kind of base, and set up again for another run. But overall, we have our market counts are still on the lower end, but they're improving from zero just a week ago. And we have a 30% market exposure for the Nasdaq, and we have 55% for the S&P, and we don't have any institutional selling days, which is a good sign. So let's go ahead and take a look at the Nasdaq. You can see here that we're below the 200-day moving average. That's the black line. And we have the 50-day moving average, which is this red line, declining. So it looks like at some point they're going to meet and cross, and that's the death cross that you sometimes hear about. And we'll see what happens. I mean, the markets is so far it's made a stand. We did make a low here, and we had a huge move up. A lot of times, though, in the middle of bigger corrections or bear markets, you get these really giant moves going on. So we've been seeing a lot of volatility going on down here as the market's trying to put in a bottom. Well, we don't know if that's going to be the bottom or just a low and hit to new lows. But there's a difference between just putting in a bottom and actually having a bottom that holds and is now showing a lot of strength. So we're not there yet. We're just at the first stage of just have seen the Nasdaq stop going down, and it'll probably have to build a little bit of a base around here and then determine what it'll do. Either break out the top and try to make another run, or it's going to break out the bottom. So we don't know what it's going to do, and we'll be, of course, watching that. The S&P is acting quite a bit stronger. It's getting support here at its 200-day, the black line, and right between the two, it's just a little technically stronger. Buyers have just come in, more often than the Nasdaq, and so again, we have no institutional selling days. But we're also getting declining volume. I wanted to point that out too in the Nasdaq. As we've been kind of making this rally, we're getting lower and lower volume. So not a great sign. It's not showing that the big institutional players are really interested in putting a lot of money to work, but at least they're not taking a lot of money out of the market for both indexes. So, but that's the indexes. So if we take a look at those are the two main indexes, I'm sorry. If we take a look at some of the other indexes, the Russell, the S&P 400, we're still pretty much in solid red. Most of them are below their 50 or 200-day moving averages. And if we go a little deeper into the technicals, here you can see the 52-week highs and lows in this red box. And again, you can see despite the strength in the indexes and in trying to rally, we're really not getting a lot of strength in individual stocks. For almost, we're almost at 2.5 weeks here. 50-week lows are outpacing the 52-week highs quite a bit. And even in the last few days, showing some strength, we're getting more 52-week lows. So it's not a great sign. You can also see here there's not a lot of stocks that are broken out and not plunged below their buy zones or hit the 5 to 8% sell zone. You just see just a 10 days ago, we had an extreme number, 88 and 84 stocks. I don't think I've seen that. And even in some of the strongest bull runs, most of these were commodity related stocks and oil and gas stocks. And then they just all fell off a cliff. I mean, very quickly we went from 84 to 6. So really difficult market and quite volatile under the surface. So it's giving us a lot of signs of caution. And of course, our system's telling us not to be very invested in the indexes and basically not invested in individual stocks. So just a few more charts here. We've talked about this one before. This is the percentage of Nasdaq stocks above their 200-day moving average. And we're still under 20%. That's a bear market that's under the surface. Call it a stealth bear market. And it's basically killing most Nasdaq stocks. And if it wasn't for the big caps holding it up, we'd probably see the Nasdaq, down 30-35% or more, which may happen, but we don't know. So we'll see. One thing I want to talk about here is that, of course, the market's very concerned about interest rates. When they're going to start, how many there's going to be, and is it going to derail the whole long-term bull market? So, but interesting though, stocks usually perform well after the first couple of rate hikes. And it's usually only after 3 to 5 hikes that the market starts getting into trouble and we start seeing larger corrections or even bear markets. But interesting though, what's really happened most of the time is the fears about coming rate hikes that have led to stocks undergoing 10 to 20% corrections, not so much the actual rate hikes. So that's something to watch out. And one thing you can actually see here from the chart, just the first date of first rate hikes, and then seeing over the next 3, 6, and 12 months, it's been actually quite bullish. Partly because it takes, once they start hiking, the market gets a little more, generally gets a little more insight into what the Fed's actually going to do, and a lot of times it turns out to be more bullish than they think, and so the market ends up doing quite well. Maybe this time around we're in a maybe different spot, because we've sent interest rates down to 0 and negative real interest rates really can't go much lower, and we're starting to see the inflation we haven't seen in 30 years or more rearing its head very quickly. And so it's a little bit different situation. We've talked about that in the other videos about this could be something that derails the long-term secular bull market. So, one final thing I want to say here, usually when we start getting to the bigger bear markets, we start getting an inverted yield curve, which we don't have now, but it's something to watch out for. We continue to get a lot of inflation, the rate hikes going on, and then we get an inverted yield curve. It'll probably be a pretty poor environment for stocks heading higher. So just to wrap things up, we have a lot of volatility now. We're not so much in the indexes, though we have some, but we're really getting big moves in a lot of stocks. And when they're missing their earnings, they're really getting punished badly. You can see these big moves in Meta platforms, which is formerly Facebook, went down 25%. Snap went down huge, but then I think bounced back up on Friday, 50-something%. Alphabet and Amazon had big moves, and these are huge trillion-dollar companies. So, and then under the surface, there's been a lot of other names that have just made big moves. So, when volatility is high, it makes it difficult to invest because it's very easy to just get into something and within a couple of days you can be down 20-30% or up 20-30%. So it just makes you look to caution going forward. And despite the indexes rallying again, it's a dangerous market. We have the stealth bear market going on under the surface, and a lot of the rallying going on is is the big snapback in beaten down tech and growth names, and that continues to go on. I mean, as every time those stocks go down, we're talking a lot of the software stocks, the growth stocks, names like Paycom or the Trade Desk. Coupa software, there's a lot of them. As soon as they start going down, the buyers are disappearing. So far, though, a lot of them are just getting their heads handed to them, like Cathie Wood, because they keep buying the dip, and the dip keeps coming. So that's why she was down close to 60% recently. And just going back to individual stocks, with the exception of oil and gas and a few other commodity sectors, there's really nothing going up. And the market just needs some time to repair itself, to end the selling in the Nasdaq stocks, and let them bottom out wherever that's going to be. It could be a lot higher. It could be this is near the bottom. So, and finally, we have the mega caps still holding up the market averages. If they start to sell off, it's been mixed. Some of them have gone up, some down. But as interest rates continue to go higher, and if they go higher in a greater frequency, all those stocks will go down despite their earnings reactions. So really the key things to watch are just the inflation numbers, interest rate direction, and rate hike frequency. Those are the things the market is most concerned about, and if they worsen and for investors' expectations, we'll see a big leg going down again. If they turn out to be not as bad, we'll probably either stay around where we are or even try for another rally. So we'll be watching all this in our service, and we'll be back next weekend with another video. Okay, thank you.